interesting question. So looking at the last 5 years, I believe it's fair to say that it has been a very turbulent time for global markets. It started off with a period of low rates as the governments tried to support the economies during the COVID lockdown. However, soon after, we saw a sharp rise in interest rates, with central banks stepping in to curb inflation. More recently, the markets have been driven by more positive news, especially around innovation, initially in the healthcare space with the GLP-1s, but then more recently with the artificial intelligence boom. And obviously, not to mention, this period has also been impacted by geopolitical events that haven't helped with the volatility in the markets. Within this backdrop, UK has clearly lagged the other developed markets over the last 5 years. However, I believe that there's still hope to be optimistic. If you look at the more recent period, so year to date in 2025, UK has actually performed very strongly, particularly compared to the European markets. Looking at the underperformance over the last 5 years, I believe this is partly driven because of the structural differences within the UK and the US. For instance, in the UK, the IT sector only makes up 1.6% of the index compared to US, where it's 35% of the index. So that itself tells you there's a big differential. And with the AI trade being quite topical right now, UK clearly has been left behind. However, there's also a cyclical element to this. So for anyone sitting in the UK, it's hard to be optimistic given the stubbornly high inflation and also signs of labour market weakening. But that's not the true story for UK. I think given these factors, UK now trades at a large discount compared to the developed markets. And I believe that really sets the stage for future outperformance. So sitting here today, I actually feel very optimistic about investing in the UK markets. So when the fund was launched, we actually noticed a big gap in the UK income space and thought that our value approach offers something that's truly differentiated. In terms of how we apply the value philosophy within this space, we're very much bottom-up stock pickers, grounded in fundamental research. We're long-term in terms of our time frame, so our average holding period is over 5 years. And we believe that this gives us a strong competitive advantage relative to our peers. We tend to take a very contrarian approach, so we're not afraid to take big bets where we have strong views. And finally, we run a very high conviction portfolio that tends to be very concentrated with strong bets. And all in all, this has allowed us to deliver very strong returns for our clients, but at the same time, we've managed to achieve a dividend yield that's above the broad benchmark and achieve our income objectives. So I would say that our approach actually has been highly complementary to the income objectives of the fund. That's a very good question. So we describe ourselves as bargain hunters, but we are always conscious of getting into stocks that look cheap today, but because of the fundamental headwinds facing the company, can get even cheaper. To avoid this, we have a value trap analysis that we run for all the holdings within the portfolio, but also for any new names that we might be considering. Within this framework, we're ranking stocks on 3 criteria on a score of 1 to 10, with 10 being high and 1 being low. The first criteria looks at the structural outlook for the company. The second one looks at leverage, both on an operating basis, but also the balance sheet. And the final criteria looks at management quality. We then sum all these criteria to get a final score and overlay that with the probability of a tail risk event. The companies that score towards the bottom end of this analysis are generally potential value traps. This is then followed by a second step where there can be 3 potential outcomes for the companies that we've identified. The first one being engagement. This involves engaging with the company to address the risks that we've identified. The second one is to limit our exposure to the company. In this scenario, we'll hold on to the name, but we will limit actively adding to the name. And the final one is to divest if we really think that the risk reward is not attractive. As an example, Currys is a recent name that we identified as a value trap. We've held it in the portfolio for many years. However, back in 2023, we got really concerned around it. And to run you through the analysis, so on the structural outlook, Curry scored poorly because of the threat from online competition, particularly from Amazon, but also there were many other players in that space. On leverage, given it's a consumer cyclical business, it already carries a very high operating leverage. But when earnings were depressed in 2023, it became a big problem from a financial perspective as well. And we saw a huge risk there. At this point, we engaged with the company and advised them to cut their dividend, as well as consider other strategic options to address this near-term risk. The company then announced the sale of their Greek business, which addressed some of these issues. However, inherently, we feel on the leverage front, it continues to rank very lowly. Finally, on management, Currys historically has done a good job in that the management was very successful in turning around their UK business despite the structural headwinds. However, in 2023, they had a huge profit warning because of the issues in their Nordics business, where they have historically been very dominant. But on further investigation, it was an issue of lack of management oversight. And as such, we lost the credibility in the management team and downgraded their score on the management metric. Overall, Currys then scored quite poorly on our value trap analysis, and we identified it as a value trap. As an immediate outcome, we decided to limit our position here as the share price was already very depressed with a very low valuation. However, since then, over the last 2 years, the shares are up threefold, and that's given us an opportunity to exit the position earlier this year. This is really the optimal outcome of a value trap analysis. It doesn't always work this way, but ideally, we identify the value traps and make sure we exit in the most appropriate manner. So the first area I wanted to talk about is consumer staples. I think it's been a very long time since someone has described this segment as being interesting, because historically this has actually been seen as a particularly boring part of the market, but it does have some attractive characteristics in that it's quite defensive and stable. This involves companies that are involved in food and beverages, household products and self-care, and therefore tend to be quite defensive in nature. They've also been seen as bond proxies in the era of low interest rate environment, and therefore enjoyed a valuation premium over this period. However, as we saw the interest rates normalizing and some of these companies stumbled on their growth objectives, there was a significant derating over the last 3 years within this subset. We have been selectively adding to the space, looking for companies where we believe there's strong reasons for the fundamental outlook to improve and growth to be better going forward. But we're also looking at companies that have decent management teams in place who can deliver that recovery, and also a strong balance sheet to provide some downside protection. As an example, I would like to touch on Diageo, which is a global alcoholic beverages company, and some of their brands includes the like of Guinness, Smirnoff and Jack Daniel, actually Johnny Walker. Diageo has underperformed over the last 3 years on the back of structural concerns around changing consumption patterns and consumer preferences as people are more concerned about their health, but also the impact from GLP-1s. However, part of this underperformance is also cyclical, given consumers find themselves in a very difficult environment with the inflationary backdrop, and therefore have to really cut on their spending and make difficult choices. Currently, Diageo is trading at a multiple of 14 times PE. This compares to the long-term average of 20 times, and now offers a dividend yield of over 4%. We believe at these valuations, Diageo offers a very compelling opportunity. In fact, just earlier, actually maybe I need to rephrase this. Diageo recently appointed a new CEO, Dave Lewis, who comes from his background in Tesco and Unilever. Now, he's someone that we have interacted with in the past through our investments in Tesco that has been quite successful, and we think very highly of him. His appointment has definitely increased our conviction in the name, and we have been adding to this space here. Another sector I wanted to touch on is industrials. Now, industrials is a mixed bag of companies ranging from airspace and defense all the way to airlines. It is a difficult space for value investors because a lot of the UK industrial companies tend to be very high quality with high returns and naturally tend to trade at very expensive valuations. However, I believe with our selective approach, it is still possible to find some interesting names within this sector. And as an example, I would highlight Smiths Group. Smiths Group is an industrial conglomerate and it makes mission critical components for a range of end markets. Historically, it has been seen as a good quality company, but more recently, there had been concerns around the lackluster growth in the company under the previous management team. We got into the stock 12 months ago when it was trading at 14 times PE, which was a big discount to the historical PE of 20 times. And since then, there has been a new management team in place who's already announced divestment of their two businesses, leaving them to focus in areas where they're truly dominant. We believe these changes should drive higher growth outlook for the future and higher returns. And as such, it still continues to offer a compelling opportunity. The stock has increased by 40% since we got into the name, and today trades close to its historical PE, but we believe there's more upside as going forward it should be a better company and therefore should trade at a premium to history.